Welcome to the Ontario Mortgage and Real Estate Insights Podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're focusing on some significant economic news that could impact mortgage rates in Canada. A recent surge in retail sales during December has added to the likelihood that the Bank of Canada will pause its rate cuts in March. According to Statistics Canada, Canadian retail sales jumped 2.5% in December, reaching $69.6 billion. This marks the strongest monthly gain since mid-2022, with increases seen across all 9 subsectors. Leading the charge were food and beverage retailers, with a 3.5% increase, and motor vehicle and parts dealers, which saw a 1.9% rise. Core retail sales, which exclude gasoline stations and motor vehicle and parts dealers, also climbed 2.5%, rebounding from a 1% decline in November. Analysts widely attribute December's retail strength to a goods and services tax and harmonized sales tax holiday that began on December 15th, encouraging many consumers to delay their purchases until mid-month. Desjardins noted that December's performance lifted the 3-month annualized rate of real sales growth to 10.2%, with per capita spending increasing in both nominal and real terms after early 2024 weaknesses. However, this surge in spending appears to have been temporary. January's flash estimate indicates a 0.4% decline in retail sales, reinforcing the idea that the tax holiday's impact was short-lived. Looking ahead, broader economic uncertainty could weigh on consumer confidence. Tony Stillo, Director of Canadian Economics at Oxford Economics, mentioned that uncertainty from potential trade tensions with the United States might cause households to cut back on spending, especially for big-ticket items. Andrew Grantham from the Canadian Imperial Bank of Commerce also warned that household spending in the first quarter could be impacted by growing trade tensions. He suggested that recent tariff uncertainties might have led households to tighten their purse strings due to concerns about employment prospects. Grantham anticipates consumer spending to slow in the first half of this year, before potentially picking up again in the second half of the year and into 2026, provided that a worst-case tariff scenario is avoided. The implications for the Bank of Canada are significant. December's stronger-than-expected retail sales support the argument that the central bank will hold rates steady in March, with market odds already placing a cut at just 30%. BMO economist Shelley Kaushik pointed out that even if momentum fades into the new year, these figures bolster the case for the Bank of Canada to pause its rate cuts. Desjardins senior economist Maëlle Boulay-Prézeau shares this view, noting that fourth-quarter annualized real GDP growth is tracking at 1.9%, slightly above the Bank of Canada's January forecast of 1.8%. However, Boulay-Prézeau also cautions that high housing costs, a wave of upcoming mortgage renewals, and the possibility of a trade war with the United States could dampen consumer confidence and spending later in 2025. She suggests that while the Bank of Canada might pause its rate-cutting cycle in March, this could be just a temporary stop, with the central bank likely to resume rate cuts thereafter. Let's shift our focus to the Toronto housing market, which is currently experiencing a significant increase in new home listings, yet seeing relatively low buyer activity. According to the Toronto Regional Real Estate Board, nearly 20,000 homes are up for sale within the Greater Toronto Area as of January. This marks a substantial 48.6% increase in new listings and a 70.2% rise in active listings compared to the same time last year. However, the number of sales transactions has fallen by 7.9% during the same period. This trend is leaving many realtors and sellers disappointed, as they were hoping for a recovery following a challenging 2024. In a recent report, economists from the Royal Bank of Canada provided some context to these numbers by comparing the real estate markets in major Canadian cities. Their analysis reveals that Toronto experienced the third largest year-over-year decline in home sales among 6 major markets, with only Fraser Valley and Calgary seeing larger drops. Despite this, Toronto has seen the biggest surge in new listings. In comparison, Vancouver also saw a significant increase in listings, but this was somewhat offset by a modest rise in sales. The Royal Bank of Canada report further highlights that while the Greater Toronto Area saw a 10% increase in sales between December 2024 and January 2025, when seasonally adjusted, the more noteworthy development was the 26% jump in new listings during this period. It appears many sellers are positioning themselves ahead of the spring season, anticipating a rebound in demand. As a result, buyers now have more choices available to them, which is putting downward pressure on prices. Interestingly, the number of active real estate listings in Toronto has not been this high since 2009. The multiple listing service home price index remained unchanged from December and was up only 0.5% year over year. However, condo prices have been particularly affected, decreasing by 3.4% from last year due to the abundant inventory. Now, let's turn our attention to a crucial warning from the Bank of Canada delivered by Governor Steve Hamoen. He recently addressed the Mississauga Board of Trade, emphasizing the potential economic fallout if the United States escalates its trade war with Canada. Hamoen cautioned that broad-based tariffs on Canadian exports could significantly stifle economic growth, weaken the Canadian dollar, and put upward pressure on inflation. Hamoen was clear about the severe consequences of a prolonged trade conflict, particularly if Canada retaliates with its own tariffs. He stated, "Increased trade friction with the United States is a new reality," and warned that such a shock would not be temporary. Instead, it could fundamentally alter Canada's economic trajectory. According to Hamoen, if tariffs are long-lasting and broad-based, there may not be a bounce back, and while Canada might eventually regain its current rate of growth, the level of output would be permanently lower. This could lead to an immediate decline in exports, triggering production cuts and job losses. Exports are expected to fall by 8.5% in the year, following the implementation of tariffs, with business investment contracting by nearly 12% due to higher costs and reduced confidence. The impact of retaliatory tariffs would also drive up prices for many imported goods, as about 13% of Canada's Consumer Price Index basket consists of goods imported from the United States. Hamoen highlighted that a weaker Canadian dollar would exacerbate this issue by making all imported goods more expensive. For interest rates, Hamoen noted that while the Bank of Canada has been steadily cutting rates as inflation recedes, the central bank would have limited ability to shield the economy from a trade shock. Monetary policy could support domestic demand, but the Bank of Canada would need to be cautious to avoid stoking inflation further. Monetary policy can help smooth the adjustment by supporting demand so it does not weaken too much more than supply, Hamoen said. But it cannot restore lost supply or fully offset the economic damage. This presents a particular challenge for mortgage borrowers. While a weaker economy might support further rate cuts, if inflation remains persistent due to rising import prices, the Bank of Canada could be forced to hold rates higher than anticipated. Hamoen stressed, "Simply put, monetary policy needs to ensure the increase in inflation is temporary." Beyond monetary policy, Hamoen emphasized the need for structural changes to counteract the negative effects of a trade war. This includes reducing interprovincial trade barriers, improving labor mobility, and investing in better east-west transportation links to expand access to overseas markets. However, while these policy shifts could help in the long term, the immediate outlook remains challenging, with a protracted trade conflict likely to sharply reduce exports and investment, cost jobs, and boost inflation. Hamoen concluded by noting that the uncertainty alone is already causing harm. As we navigate these uncertain times, it is crucial for policymakers and stakeholders to consider both immediate and long-term strategies to mitigate the potential economic impact. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.